Hello friends, my name is Krishna. Welcome back to my YouTube channel. Today's topic is going to be on journals again. I'm going to tell you the template, journal template, how the template is supposed to be, and we will work on some transactions. We will figure out how to prepare the journal entries, right? I request you to watch this video till the end. It will be definitely useful to the people who started their career in BCom or CA Foundation or +1 and +2, right? So let us start. How the journal template is going to be. Journal template will be like this. First column will be date. Next column will be particulars. Next column will be LF number. Next debit. Next credit. This is how the journal template is going to be. Let me tell you, date is what? Date is nothing but the day the transaction has been occurred. Transaction has been occurred. That is the date you need to put here. Particulars. This is where we need to write which account to be debited, which account to be credited. That is what we need to write here in particulars. And we also need to write a narration. What do you mean by narration? Narration is nothing but explaining about the journal entry, whatever you posted, right? Next column is LF number. Ledger folio number. LF number is nothing but ledger folio number. Once we post the journal entry here in journal book, from here it will be posted again in the ledger. So when we are posting this journal entry in journal book, and from there if you are carrying forward to ledger, you should know where this entry is posted in ledger, which page this was posted in ledger. So that is the reason why ledger folio number is required. Ledger folio number is nothing but in ledger book in which page this entry has been recorded. So that number, page number has to be mentioned here, LF number, right? And then debit and credit. So this is called journal book. This journal book is also known as primary book. Why this is called as primary book? Because the day you incur or the day the transaction has been occurred, the same day, immediately the transaction will be recorded in this book. So that is the reason why this book is called Book of Primary Entry or Primary Book. These are the names we call. Book of Primary Entry or Primary Book, Journal Book. These are the names. The first time when we incur the transaction, the first time the transaction has to be entered in this book, right? So this is how the journal book is going to be. This is the template we need to follow when we get into an examination, when we start writing the journal entries. This is the format you need to draw and start updating the journal entries. Start preparing the journal entries. Clear? Right. Let me take out this and I'll start explaining some journal entries. Right. So let us start with first journal entry. Ram started his business with 10,000 rupees capital. Let us take this transaction. Ram started his business with 10,000 rupees cash. How do we record this transaction into the books of accounts? That is something which we need to learn. So let us say, first thing, I will try my level best to explain how to prepare the journal entries without any much difficulty. And fundamentally it should be right. So If we start preparing or start thinking the journal entries in this fashion, you will never get into mistakes. So let us say we always need to think from business point of view, right? So let us say B means business. B means business. So from business point of view, how do you record this transaction? That is what we are going to do. So Ram started his business with 10,000 rupees capital, right? So when he started business, what comes into the business? First question. What comes into the business? What comes into the business when we start business with 10,000 cash? Cash comes into the business. See the arrow mark here. Comes into the business is cash. What goes out from the business? Next question. What is the first question? What comes into the business? Cash. Next immediate question. What goes out of the business? When Ram is bringing cash into the business, nothing goes out. Nothing goes out. So this is not applicable. If nothing goes out, next question. Who is the giver of the cash? What question you need to ask yourself? Who is the giver of this cash to the business? Who is the giver? Ram. Ram is the giver of this cash. Right? Now, cash comes under what type of account? Cash is an asset. Right? Cash is an asset. It comes under real account. Clear? Ram. Ram is a person. It comes under personal account. Now, how do we define the entry? Real account. What is the golden rule? Debit what comes in. Credit what goes out. Here, what is coming in? Cash. Since cash is coming inside into the business, you need to debit cash. Cash account to debit 5,000 rupees. 10,000 rupees. Right? Then nothing goes out. Who is the giver of the cash? Ram is the giver of the cash. Ram comes under personal account. Then what is the principal under principal account? Personal account. Debit the receiver, credit the giver. Is he giving to the giving cash to the business, or is he taking receiving the cash from the business? He is giving cash to the business. Ram is giving cash to the business. So Ram is a giver. Debit the receiver, credit the giver. Since he is the giver, you need to credit him to Ram account. Correct? For 10,000. But we don't credit Ram. We don't credit Ram. Instead of crediting Ram, what we do is, since he brought in that as a capital, we write it as capital account. So we don't write to Ram account. We credit capital account because Ram is the proprietor. He is bringing that cash into the business as a capital. So instead of crediting Ram account, we credit capital account with 10,000. This is what I was telling in my previous video. Capital account is a personal account. Why capital account is a personal account? Capital account is credited on behalf of a person. Capital account is credited on behalf of a person. Hence, capital account is also a personal account. What type of person? It is a representative person. It is being credited on behalf of a person. Capital account is credited on behalf of a person. Hence, capital account is a representative person. Are you clear with this entry? Anyway, I'm going to explain these entries. Few more problems, few more videos, maybe another 3-4 videos I will explain only on journal entries, because journal entries are very, very important. Unless you know the basics, fundamentals of journal entries, it is very difficult for you to survive. So that is the reason why I'm saying these journal entries learn properly, right? Now you understood. Let us move on to the next one. purchased goods for cash 5,000. Purchased goods for cash 5,000. Now again, let us start with B. B means business. You should always write journal entries from business point of view. This is as per business entity concept. What business entity concept says? Proprietor is different from the business, right? So you should always write journal entries from business point of view. That is the reason B means business. Now, purchased goods. Business purchased goods for cash. When we purchase the goods for cash, what comes in? First question. You should always ask this question. I explain like this only. Then only you will understand how to define the journal entry. First question, as soon as you see the journal entry, please question yourself. What comes in? What goes out? These two questions are very, very common. So, purchased goods for cash. So, what comes in? See my arrow mark. What comes into the business? Goods. Clear? What goes out? Next question. See my arrow mark. What goes out? When we purchase goods for cash, we give the cash, we get the goods. We in the sense business. We in the sense business. Business get the goods and give the cash. So what comes in? Goods. What goes out? Cash. Clear? Goods comes under what type of account? Real account. Cash comes under what type of account? Real account. Goods, as I said in the previous video, as long as goods are in my inventory, it will be treated as a current asset and it will come under real account. Hence it is a real account. So goods comes in and cash goes out. What is the real account principle? Debit what comes in. Credit what goes out. Here what is coming in? Goods. So debit what comes in. Goods comes in, so I need to debit goods. Goods account to debit. What goes out? Cash. Comes under what account? Real account. What is the principle? Debit what comes in, credit what goes out. Here cash is going out. Credit what goes out is applicable. So I need to credit cash account for 5,000. This is the journal entry. But instead of debiting goods account, since we purchased the goods, instead of debiting goods account, since it is a purchase, you can debit purchases. You can debit purchases account. Clear? This is the journal entry. Purchases account, there is no harm in debiting goods account, right? So don't worry about that. I'm just giving you different options because from theory point of view, when we purchase goods, you should always debit purchases, theoretically. When it comes to practical, it's a different story altogether. We debit inventory only. So don't worry about that. What we are doing here is for examination point of view, when we purchase goods, goods comes in, we debit goods, but since the goods are being purchased, instead of debiting goods, what we debit? Purchases. Very simple. And purchase account debit to cash account is the journal entry. Clear? Right. Let me move on to the next entry. Sold goods for cash 6,000. This is the next entry. Sold goods for cash. Again, from business point of view, always write B. Very, very easy to understand. Write B. B means business. Now, what is our next question? What comes in? What goes out? Very simple. Here, when we sold goods for cash, what comes in? When we sell goods for cash, so cash comes in, right? So cash. What goes out? Goods goes out. Clear? Goods. Cash comes under what type of account? Real account. Goods comes under what type of account? Goods is also an asset. It comes under real account. You need to refer my previous video so that you will get to know all examples I have given in my previous video. So cash is the real account. What is the golden rule in real account? Debit what comes in, credit what goes out. Here what is coming in? Cash coming in, right? Cash is coming in here. So you need to debit cash account for 6,000. Very simple. What is going out? Goods. Real account. Debit what comes in, credit what goes out. Goods going out. So you need to credit goods to goods account. 6,000. Instead of crediting goods, what you can do is, since the goods are sold, you can say sales account. Instead of crediting goods, you can say sales account. So what is the entry here? Cash account to debit to sales account. Clear? Right. Next video onwards we'll go fast, but first video I just wanted to give you the full knowledge how to define the journal entry. Hence I might take little bit of additional time here, but you should learn this. Then next, we understood capital, we understood goods purchased for cash, we understood goods sold for cash. Now second one, next point, goods purchased from Raju for 6,000. Goods purchased from Raju 6,000. Examination point of view, to be very, very careful. Goods purchased from Raju. Did they say purchased for cash? No. But how do I see this transaction? Is this goods purchased for credit or purchased for cash? This is the confusion we always have, right? If they do not mention about the cash, nowhere it is mentioned. Goods purchased from Raju, they did not mention the cash here. One. Second point, if they are not mentioned about the cash, next question you need to ask, did they mention about from whom these goods are purchased? Raju. Since they have given the name of the person from whom the goods are purchased, and since they did not mention about cash, this transaction has to be considered as a credit transaction. Again I am repeating. How do we treat this as a credit transaction? Goods purchased from Raju, they did not mention about the cash. Is it the only criteria? Yeah, they did not mention the cash, that's fine. But did they give the name? Yes. If they don't mention the cash and if they give name of the person from whom the goods are purchased, then it will be considered as credit transaction. Very, very important, guys. This is for basic +1, +2 and CA foundation people. They need to understand the journal entries very carefully. So this is a credit transaction. I'll give you another example. Goods purchased for 4,000 rupees. Goods purchased for 4,000 rupees. Did they mention anything about cash? They did not. Did they give the name of the person? No, they did not give. Then how do I consider? This you need to consider as a cash purchase. That is the beauty. Here you need to consider this as a cash purchase. Here why are you considering as a credit purchase? Because the name is given, though the cash is not given. Third example. Goods purchased for credit 3,000. This is another example. Goods purchased for credit. Did they mention cash? No. They mentioned very clearly credit. But they did not give the name. Then how do we do that? So we need to handle these three transactions properly. I'll explain these three transactions now for you to understand. First one. Goods purchased from Raju for 6,000. Here goods purchased from Raju. They did not mention about the cash. Hence this transaction will be considered as a credit transaction. Then, as usual, business. What comes in when we purchase goods? Goods comes in. What goes out? Nothing. You did not pay the cash. So nothing goes out. If nothing goes out, the next question is, who is the giver of the goods? Please remember, guys. Goods are coming, nothing is going out. If nothing is going out, the next question should be, who is the giver of the goods? Who is the giver? Raju. So, Raju you need to consider. Now, you tell me, goods comes under real account, Raju comes under personal account. Clear? Real account principle, debit what comes in, credit what goes out. Here what is coming? Goods coming in. So, goods account debit. Right? Instead of debiting goods, what I said, since it is a purchase, you can debit purchase account. Purchase account debit. 2. Who is the giver? Raju. Since Raju is the giver, he comes under personal account. Principal, debit the receiver, credit the giver. Raju is the giver. So, to Raju account. This is the entry. Clear? Right. Next. Next one is goods purchased for 4,000 rupees. Did they mention about cash? No. Did they mention about name? No. So, if the name is not mentioned, let us consider this as a cash transaction. Then I already explained this. When goods purchased for cash, what comes in? Goods comes in. What goes out? Cash goes out. Both are real accounts. Real account principle, debit the receiver. Debit what comes in, credit what goes out. So what comes in here? Goods. So what you need to do? You need to debit goods account or purchase account and credit cash account. Clear? I am not explaining much about here because I already explained cash transaction. Clear about this? Then the last one. Goods purchased for credit. Here in this transaction they clearly mentioned goods purchased for credit 3,000. But the question here is, when we purchase the goods for credit, from whom? Did they mention about the name? In case if they don't mention the name, you can use creditors, suppliers. For examination purpose I am saying, supplier. So what comes in when we purchase goods? Goods comes in. What goes out? Nothing, because this is purchased for credit. Then if nothing goes out, next question, what did I say? Who is the giver? Who is the giver? Supplier. Name is not given, then you need to assume that as supplier or creditor. Supplier and creditor are one and the same. Vendor, supplier, creditor, these are all the names, right? You can consider that as a supplier. Then what entry you write? Goods account debit, because goods comes under real account, supplier comes under personal account. Real account principle, debit, what comes in, credit, what goes out. Here goods comes in, so debit goods. Instead of debiting goods, what do? Purchases debit. And credit, supplier account. Why supplier account credit? As per personal account principle, debit the receiver, credit the giver. Since supplier is giving, I am creating supplier account. This is how the journal entries have to be recorded. I am stopping here. I have already 25 minutes over. I'll explain another video with another examples. Probably another 3-4 videos. I'll definitely shoot for journal entries. This is very important chapter. Unless you know the fundamentals, it is very difficult for you to move further, right? So thank you so much for watching this video. If you like the content, please subscribe my channel, like the video and subscribe to my channel. Thank you so much.